Hey guys, welcome to my course. My name is Zevi Shafran. I'm a wholesale mortgage lender, and I wanted to put together an A through Z course that would actually teach you how to become a mortgage loan officer, an LO, a lender, whatever terminology you want to use. Wanted to walk you through these steps, and what makes me qualified to deliver this information to you is actually own a mortgage shop in Woodland Hills, California. It's called Loanbrook Inc. And last year I originated over $50 million worth of mortgages. Of course, across the board, I would imagine most loan originators had a great year because interest rates were lower. Today they're a little bit higher than where they were last year. However, I think now more than ever, it's probably an amazing time to get involved in mortgage because it's a skill set that you build. It's a career. It's not a make money quick or come in and out type of a deal. If that's what you're looking for, then like any career, I don't think this would be the right choice for you. But if you're someone who's inquired and wondered about how you could make money in the mortgage industry and you wanted to learn all about becoming a loan officer, I think you would find this course very, very useful. And there's going to be a lot of information that I'm going to cover. So I would highly recommend you get some kind of a paper and a pen, make some notes. The only thing that I ask is I'm actually offering this course for free, and I'm going to post it on to YouTube. And I'm simply doing that because I would love to see you succeed. I'm kind of at a point in my career where I would like to teach and I would like to show and share what I've known. There's really no reason for me to keep everything I know in my head. So as a time capsule for myself, and hopefully good fortune for those who can participate and learn from me, I would love to see you succeed. The only thing that I ask in return is if you like this video, please drop it a nice comment below. Let me know what you've learned. Let me know what you're learning and what you could use help with. And give it a thumbs up and subscribe to the channel. With that, let's dive into the video and let's get started, all right? Most of the business that I do involves working with different partners. And those partners may be real estate agents, they may be CPAs, they may be attorneys, they may be insurance. And of course, there is the end user, which is the consumer, right? Structured in three different buckets, which is sales, product knowledge, and marketing, okay? So it's always hard when you're in something to get the perspective of what it needs to look like. But like any other business, once you take a step back, the business is structured around sales, product knowledge, and marketing. And so those are the three big components that I want to cover in this course. And I'm going to share with you because I think, for most of us, you're here because you want to make money, you want to advance your career, you want to make sure that whatever time is spent is something that you could use in the very near future to try to monetize, try to make money. It's not basically my idea to sit here and give you a bunch of information. It's, you getting this information is kind of like you climbing a hill. And at the end of the day, you basically want to get to the top as quickly as possible. You don't want to, go around this way. So I'm going to try to get you there as quickly as possible, for you to be able to use this information to make money. But I think what's very important is for you to understand why I'm giving you a lot of these different pieces of information. So that's how my brain works. That's how I like to break down information. I like to know why. So when we're talking about sales, we're naturally talking about being able to qualify somebody. Okay, so if somebody walked through the door today and they wanted to get a loan, I need to be able to qualify them. That's the skill set that I need to develop as a mortgage loan officer. The better I am at it, the quicker I can deliver that information, the more professional I appear to be, and more confident the client is to use my services. So that would be number one. Switching gears to product knowledge. When you're talking to a consumer about getting a loan, there's a lot of buckets that they may be able to fall into, and a lot of it depends on their credit, on their income, on their assets, on their living situation, whether they are self-employed or they work in a company. And so there's a lot of variables. And as a loan officer, it's very important that as you hear this person talk, you understand the different products that are going to be available to them, because one does not fit all. I can guarantee you that, okay? And then the last bucket, of course, is marketing, because there are different things that you can do as a loan originator to either just get leads, which, you know, basically no one knows who you are. You're talking to a consumer about getting a loan and trying to compete with 10 other loan officers, versus building a business, building a reputation, okay? Showing your skills out to, you know, referral partners, or, you know, on social media, on YouTube, and then building that circle of influence around you, which basically separates you from the competition, right? Because if you go into a forum, like a Facebook forum of any kind, and somebody inquires about a loan, and you and 20 other people answer the question, there's no real strength there in terms of reputation. But when you build content and post and build relationships, people know your skill set, they respect it, and you tend to be the go-to person for that person or that group, okay? So that is very important. Wanted to cover those 3 bases. Let's jump in to the next video. Okay guys, in this segment, I want to talk to you guys about licensing. Licensing is very important. I'm no licensing expert, but I want to give you the framework of what it takes to become licensed in this business. And there's actually 2 different ways that this could be handled. And it really depends on where you want to work. So this is an important question for you to ask yourself before you get started, okay? Now, if you're going to work on the state side, then you're going to be working on the broker side. I'm going to elaborate on that in a minute. Or you're going to work on the federal side, you're going to work for the banking institution. 2 different sets of licensing, 2 different sets of requirements. Now, on the broker side, you need to complete 20 hours of pre-licensing education. There's a company that I really like. They're called Mortgage Educators and Compliance. I will actually put a link in the description below so you can check them out. You're going to be required to complete, like I said, 20 hours worth of pre-licensing to be able to qualify to take the NMLS exam, which is a national exam. I believe they give you something like 5 or 6 hours to complete this exam. Now, that's good if you're going to work for either a broker or a direct lender. Now, if you're thinking of working for a bank, then that's different. You could inquire directly with the bank that you're looking to work for. Typically, they will have you do some courses and different things inside the bank, and they will issue you an NMLS license. Not necessarily the same way this is structured. Let's move on to the next video. Okay guys, next we're going to talk about the different regulators. We're only going to spend a minute on this because it really, like I said, depends on whether you're working on the state side for a broker or you're working on the federal side for a bank. Now, if you are working for a broker, because I'm a broker, then there's 2 regulators, basically meaning that there's 2 types of licenses that you can get with your NMLS license, okay, or endorsement. And the first one is through the DRE, the Department of Real Estate, right? Which is what I have. I have an endorsement on my real estate license, which basically means that if there's ever a problem, it's addressed through the Department of Real Estate, not the NMLS. The NMLS is basically like a middleman, like an escrow company. They're just being told what to do, right? The actual regulator is the Department of Real Estate for my license. Now, there's also another regulator, which used to be called the DBO, which was the Department of Business Oversight, and actually changed their names to DFPI, which is the Financial Protection and Innovation. And so that actually, and the reason I'm telling you is very important, because if you're getting your license and you have a shop in mind that you want to work with, but they are licensed under the DFPI, and they have a California Finance Lender's license versus a real estate broker license, then you don't actually need to get a real estate license. However, if you worked for a real estate broker with an endorsement, you would have to get a real estate license with an endorsement. So very important to know where you're going to end up working if you have something in mind in advance, to know how you're going to position your licensing. Typically speaking, to renew your NMLS license is about $300 for every year. And then if you do get a DRE license, which is a license through the Department of Real Estate, which is basically a real estate agent license, then there's some fees there. I will put links below, which you could actually reach out directly to the DRE licensing and ask if you have any licensing questions. Again, no expert in the field. And same thing for the DFPI. Okay, so you have some ways to contact in case you have any questions about that. With that, let's jump on to the next video. Okay guys, the next topic is the structure. Now, I know we're covering a lot of ground in terms of, what we're going to be covering in this course, and then the licensing piece and the regulators, but this is just, a preliminary thing that you should really know. And then the lender structure is super important, because these are things that I had no idea about when I got started. I actually got started on the bank front, and so a bank is naturally a direct lender because they have everything in-house. Now, they may not actually have it at the branch. You may be a loan officer for a branch who's a direct lender, because they're basically lending either their own money or money from a credit line, which is called a warehouse line. Either way, they have all their own personnel working for that particular company to package the loan through underwriting, closing, the whole 9 yards. So that would be considered a direct lender, which is basically, it could be a bank, but all banks typically are direct lenders or credit unions. Now, I actually am a wholesale lender. So what is the difference between a direct lender and a wholesale lender? Well, a wholesale lender could also be a direct lender if you have underwriters and closers and everyone in-house, right? And so the big difference is, and there really isn't a really big difference, is that a direct lender would actually use their team internally to go through underwriting and closing, whereas a broker or a wholesale broker would determine which lender they want to use, whether it's a wholesale. Typically it's wholesale, meaning that they don't really service the retail department or the end user. Some of them do. As an example, like a Quicken Loans, right? They have a wholesale and they have a retail division, meaning that they can solicit end user consumers, and they can solicit brokers. Some brokers don't like that at all. It's been a huge controversy in the broker environment, and there's been some advocates saying that if you're going to do wholesale, stay with wholesale, because otherwise, as a broker, how do I know that my clients in the future are not going to get solicited? But that's a completely different topic. So basically, as a broker, there is a big advantage, because if I know that the loan that is being described to me is not going to fit in this particular bank, right? As a direct lender, for an example, then it gives me the opportunity to work with any wholesale lender that I want to be able to place the loan. Versus a direct lender like a bank may have certain programs, and then if you don't meet the criterias, then there's no loan for you. So I always preferred to be a broker versus a direct lender. There is other things involved in the broker world outside of being a bank. If you do want to be a direct lender, you could be a completely independent shop where you have underwriters and closers and everything in-house. You could also be a partial shop where you might give the wholesale lender the opportunity to underwrite your file, but then you draw your own loan docs. People do that to have their names on the docs so they don't know which bank they're using. It's not really necessary nowadays. There's one other advantage to being a direct lender, is that every rate has a certain amount of credit in it, and as a direct lender, you can control whether you want to take more or less of a compensation based on how much you want to compete for the business. As a broker, you cannot do that. Your compensation is locked in if you're doing a deal where the lender is paying you directly, not the borrower. This is where it gets a little tricky because there's two ways to do a deal, and one of them is called lender paid and one of them is called borrower paid. Everything we've discussed so far is compensation from the lender directly. However, as a broker, you can sell your rate directly to the borrower and simply charge them an origination or a commission. So I know we're getting a little bit tricky here, but this is very important, especially in times like this, where rates are a little bit higher. It's good to sell your own rate because within your rate, it's not just one rate, it's a waterfall of rates. And to each rate, there's an associated credit. Borrower can pick whichever rate they want, high or low. The lower the rate, the higher the cost. The higher the rate, the more credit they get. And they could use that credit to offset your origination or your commission. Hopefully that makes sense. If it doesn't, rewatch this segment. And if you have a question, drop it in the comments below or shoot me an email. I'll be happy to explain it. On to the next video. Okay guys, the next part of the journey is being able to pre-qualify and pre-approve your prospects, right? So that's a skill set that we need to develop. Now, how do you even get started? I remember when I was at the bank for the first couple of days, I was praying that no one comes up to me to get pre-qualified because I had no idea how to do that. So let me walk you through it, because what I want to do is actually show you how it's done initially as a pre-qualification. Now, what's the difference between a pre-qualification and a pre-approval? One is basically verbal. It doesn't necessarily take a full verification of documents, credit, income, the whole 9 yards. When somebody verifies all their information, they're officially pre-approved. We're going to get into that. So the conversations that I typically have, and this is something you can do very, very easily, is basically just find out what somebody is looking to purchase. As an example, let's just use an example. Say I was having a conversation with somebody and they say that they're looking to buy a $800,000 home, right? So I would jot that down as $800,000 home, and I would ask them how much of a down payment are they looking to put down. Now, this is a key question, and I will explain to you why. Because oftentimes a lot of millennials, especially, who just come out of school with some really good jobs, especially, those that work for companies like a Tesla or Netflix or any one of those big companies, might actually make some pretty significant money. They can actually afford a bigger payment, but they don't have enough money to put down. So that's why you always want to ask that question. In addition to that, anytime you put down less than 20%, there's mortgage insurance. We'll get into all that, but just to keep it very simple, I'll show you where I'm going with this. If somebody says they want to buy an $800,000 house and they're going to put down 20%, right? No mortgage insurance. And now, mind you, this is a very casual conversation. You just met somebody, you're with a real estate agent, they're telling you, hey, this is an $800,000 house, we're interested in buying, and you say, great. Do you have a down payment? Yes, 20%. It's our first home. Can we have a gift? Yes. Owner-occupied can always have gifts. Again, we'll get into all that, but just keeping it simple. So 20% of 800, we know is $160,000, right? That means that my loan amount is going to be $640,000. 800 minus 160 equals 640. Now, in my head, there's a baseline of a payment. Typically speaking, and this used to be truer about a year ago than it is today, but if you take a loan amount, in this particular case 640, and you cut it in half, which gives you 320, and you remove 2 zeros, you have a payment of $3,200. Neat little trick, right? Now, it's not exactly accurate because this was based on an interest rate roughly around 4.5%. And today, we're probably around 6%. So let's say I take that $3,200 and just in my mind, I want to play super conservative and I bump it up to $3,500. Now, this would be a payment for principal and interest. not taxes and insurance, which we will need to include. So now I know I have a principal and interest payment of $3,500. Mind you, I'm just having a conversation, and I already know in my head $3,200. I'm going to bump it up to $3,500 to be within the interest rates today. Now I know that this property has property taxes and insurance, and if the property is about $800,000, I'm in Los Angeles, so LA County is about 1.25. I can imagine the property taxes and insurance are probably going to be somewhere in the neighborhood of somewhere between $1,000 to $1,200. So I'm just going to add in about $1,100. This is all happening in my head because I'm running some really basic numbers. So I know that $3,500 plus $1,100 is roughly around $4,600. Now you don't need to do this in your head. You could use a calculator to do it. Here comes the tricky part. Now, if you know that somebody's expense on their mortgage, principal interest, which was $3,500, taxes and insurance, about $1,100, we're at $4,600. And we know that, and now there's something that we're going to get into, but the agencies, the government agencies buying these mortgages, Fannie and Freddie Mac, will go up to 50% of your gross income, before tax income, to qualify you. Then we know that 46 is 50% of 92, right? 46 is 50% of 92, which means that if you have a borrower standing in front of you and I want to use 50% of their income to qualify them for the house, and I'm going to assume for a minute that when I run their credit, I'm going to see no liability whatsoever, then I know that if I use the max qualifier of 50%, which I may or may not be able to, this person's got to make a minimum of $9,200 a month to qualify. So if I took a minute to do this, just by talking to this individual, and I tell him, so you want to buy this $800,000 home and you're going to put down 20%, your loan amount's going to be $640. Do you make at least $9,200 a month before we talk about any of their other expenses on their credit report? And they say, yeah, I make like 12 or 13,000. You're good to proceed at that point. You can move forward. If they say, no, I actually make like $7,500 a month, stop right there. Don't waste any more of your time. They cannot afford this property. Also, another little thing, if this $800,000 home was actually a townhome and the homeowner association was, say, a minimum of $400 a month, that $4,600 payment that we discussed for property tax, for principal, interest, taxes, and insurance now has HOA of another $400. That $4,600 is now $5,000, which means that they would need to make $10,000 to qualify. Does that make sense? So these are just simple conversations you're having with individuals standing in front of you, where you can gauge if they're even on the right track to get the loan that they need. All right? So that's a basic pre-approval, or pre-qualification, not a pre-approval, a pre-qualification based on information given to me that now I can use to determine if I should continue to pre-approve this individual. On to the next video. Okay, so we just finished pre-qualifying the individual, and we know that there's potential there to move forward with a transaction. What's next? There are several components here that never cross one another, and I'm referring to assets, credit, income, and then we have to check if the person has a valid ID, if they're a citizen. So we have to look at all those. Now, something that I think is super important, none of these items will ever cross one another. They always go in individual. We think of it as waterfalls. So think about it. A waterfall always goes down, never goes sideways. So when you're talking about assets to somebody, don't ever confuse it with credit or income or anything else in the transaction. And that's the point that I want to relay. So let's get started. Assets is going to be first. So you talk to that individual when you did that pre-qualification, that verbal conversation, and they told you that they potentially have 3%, 10%, 20%, no percent. What should you keep in mind? Couple things. Number one, you always want to request at least 2 months worth of bank statement. Now, it really depends if they're a wage earner, meaning they just get a check, right, from a company. So, their money is going to be pretty consistent in what they make and what they're able to save. So if there's a very large deposit that you see on the bank statements, it would have to be sourced. As an example, you're working with somebody who makes $4,000 a month, right? And then all of a sudden, you see a deposit for $40,000. Clearly, it didn't come from the work unless they got paid a bonus or large commission, in which, this is something we're also going to talk about. But just being consistent with the amount of money that they make, we want to know, where did that money come from? Now you're talking about sourcing the deposit. So typically speaking, if you have 2 months worth of bank statements and the money has been sitting there for 60 days, you don't need to source anything. It's already been there. And if there's any money being added to it, as long as it's logical, meaning that, that person makes $4,000 a month, you could see that income is coming in every single month, and then they may have a savings account where they transfer some money. All makes sense, right? But if they told you in the initial conversation that they want to put down, as an example, 20% to avoid mortgage insurance, right? Because mortgage insurance kicks in anytime you have less than 20% down, and they don't actually have that money available in their account. As an owner-occupied transaction, you could actually get a gift fund for the down payment. You still need to be able to have money for reserves. And something that I should mention to you, you don't need to memorize all this, because what happens is there's 2 agencies that buy mortgages typically, and they're Fannie and Freddie Mac. They're government-backed, and their guidelines are actually posted on the internet, and it's national guidelines. So it's not like you're gonna have one conversation with, a person here, and then another loan officer is gonna have a whole different conversation with them if you're both talking about a loan that uses your tax returns. And it gets a little tricky, and I'll explain to you why in a minute, because there's other buckets which we're completely not getting into in this course, because the purpose of this course is to go through what we call QM loans, which is qualified mortgages. And the qualified mortgages are the mortgages that are being sold to Fannie and Freddie Mac. Therefore, the guidelines are national, so you should be able to have these type of conversation with any borrower, regardless of the state that they're in. Something to keep in mind. Okay, so you could look all this up, and the way you look it up is basically Fannie Mae or Freddie Mac matrix. So the matrix would actually show you the minimum credit score that you could actually use to qualify a borrower, which is typically 620. It would show you the different loan to values that are available for different properties, meaning 1 through 4 units. Different down payments are available for somebody who's trying to buy a single family residence, a condo or a townhouse, right? Then to somebody who's trying to buy a duplex, a triplex, or a fourplex, there would be different down payment requirements. Anything from 3% down to a first-time home buyer, to 5% down somebody who's not a first-time home buyer, to potentially putting down 15% down for a 2-unit, and then 25% down for a 3 or a 4-unit. Completely different down payments. However, something that you should keep in mind, giving you guys some good information there, is that as the unit mix changes, so does the loan limit. Important. These are very, very important things to keep in mind. And the reason is because you're trying to stay away from jumbo financing, specifically as a loan officer who does not work for a bank. These loans that are being sold to Fannie and Freddie Mac are typically your bread and butter. And so when you switch over to jumbo, if you're on the broker side, you're not going to be as competitive as the retail level bank, because those are the type of customers that come through the door that, you know, the bank basically picks and chooses the absolute best borrower who will qualify at a lower debt to income ratio. We'll get into that as well. Who has a higher credit score, who's willing to put down 20%, right? Who has more reserves. So that's not what we're discussing here right now. We're trying to get through the national guidelines for Fannie and Freddie Mac, where you could actually compete with anyone else for the business as, you know, a loan officer working potentially at a broker channel. So we're gonna keep going. Gift funds are only available for owner-occupieds, not for investment properties. So if somebody's telling you they're trying to buy an investment property, then scratch it. You cannot get a gift, and if they don't have enough money, and reserves, very, very important, reserve requirement in their account for whatever the loan limit is, it changes based on loan limits, then you're not going to be able to help them out. And then, as we've discussed, whatever amount is in there needs to be seasoned for a period of, you know, 2 months, because it's always, you know, you're always going to be conditioned for 2 months worth of business bank statements or personal bank statements. And if you see the deposit going in and it doesn't correlate to the type of income that the individual makes, then of course you're going to be conditioned to figure out where it came from, meaning seasoning. You're going to need to document the transfers, and then ultimately, if it was a gift and it's not an owner-occupied, it's going to get kicked out. Okay, that's all we're going to cover on this segment. Next, we're going to talk about credit. On to the next video. Let's jump into the credit piece. Credit is something that can make or break your transaction, and you might be thinking to yourself, yeah, at school, I can just check a Credit Karma type of a situation. I get, you know, screenshots and so forth. It's a different algorithm. When you're running a mortgage credit, then you are checking credit on Credit Karma or any one of those, you know, credit cards and banks that allow you to periodically just log in and check your credit score. There are 3 different bureaus that report to, compose a credit score, and we typically use the middle credit score. Now, there are some changes coming. There's always changes in the mortgage industry where, and different lenders try to make it slightly easier, but they're portfolio lenders where they're actually going to average out. Typically, Fannie and Freddie Mac will not do that. They'll basically look at, if there's 2 borrowers, they're going to, look at the middle scores, and whoever has the lower credit score, that's who they're going to use to qualify the loan. And sometimes that's a challenge because it hits your pricing. You might have a credit score here of, like 680 and a credit score here of 740 mid scores. You're going to have to always revert back to the lower credit score. Just something to keep in mind. Now, some people are clever and they say, well, not a problem. I've had this account and I'm just going to dispute it. So it's removed from my credit report, and then I can run my credit score will go higher, which is true. However, if there's any type of disputes on the credit report, you're going to need to rerun the credit. So I don't recommend you do something like that. If there's any type of derogatory items that can be removed in advance, I would recommend to do that. Typically, credit takes 30 days to cycle. So another point is that credit is very cyclical. It goes up and down all the time based on usage. All right. Now, I'm not a credit counseling agency, but I can tell you from running a lot of credit reports, basically, if credit is maxed out on any credit card or revolving line, typically it hits the credit score pretty hard. You want to keep credit somewhere around the 50% benchmark, meaning that closer you are to 50% of the limit. As an example, you have a credit card, the limit is $5,000, and right now you're maxing it out at around $4,900. It's gonna hurt your credit. Bring it down to about $2,500. $2,000, and you're going to see a significant jump in your credit score. Now, you don't want to do that right before you get into the transaction. You want to do it about 30 days before, because it takes about 30 days for credit to cycle. And now some lenders will actually not allow you to rerun the credit in the transaction. They will only allow to use the actual credit that they see when they initially ran credit. Now, that's also known as an overlay. An overlay is something that's not necessarily a Fannie or Freddie Mac guideline, but something that the lender puts into place as a hard stop to make sure that their underwriting process is always a most conservative approach to your income, to your credit, to your assets, and so forth. All right. Now, two other things I want to mention. If you're in the transaction and there is an account that needs to be removed or updated, there is a possibility to do a rapid rescore. A rapid rescore is not something that you as the borrower are allowed to pay for, so that's something you should always keep in mind. If you're going to go in and become a loan officer and you say, no problem, I'm going to go ahead and fix this person's credit, you're going to actually have to pay for it. It's not legal for the borrower to pay for a rapid rescore. It could be done. It takes about a week to get removed completely. Sometimes it's quicker, but it does cost a lot of money. It could cost about $50 per credit agency, and you need to, for one account, you need to pay all 3 credit agencies. It could be about $50 a piece, $150 to have this thing removed in 1 week. So it gets quite pricey, especially if there's more than one account. So if you're working with a borrower, always important, tell them in advance to take care of these items so you don't have to do it in the transaction. The last thing is, before you run anybody's credit, make sure the credit is not locked, because if it is, then Experian is always the group leader. Will stop right there. Will typically cost about $8, and then you're going to need to rerun the credit. Sometimes they can pull in the 2 other bureaus, but if they can't, you're going to need to rerun the credit. So just something to keep in mind. Also, something I'm going to throw at you is that a lot of lenders do a soft pull, typically right before closing, just to see that you haven't extended any credit throughout the transaction. Some people are clever, they get into the transaction and then they go buy a car or something that will add on to their liability. They think, we already ran my credit, it's fine. It actually isn't. Credit is good for 90 days. If it expires in the transaction, you need to rerun it, and before closing, lenders will run a soft pull just to make sure, which is not a hard inquiry, but to make sure you haven't extended any more credit. And if you did, guess what? It's going to need to get pulled into the transaction. Your debt to income is going to get all screwed up, and you may or may not qualify. So just something to keep in mind. That was credit. Let's move on to the next video. Okay guys, we're talking about income. This is a biggie, and it's something that gets pretty tricky, to be quite honest. I'll go through it with you. There is some pointers that I can give you to help you out, because this one is basically what's going to make or break your transaction. The way you add up income, if you don't add it correctly. This is something you definitely want to spend a lot of time learning, and I'm going to give you this pro tip, which is going to help you out immensely. There are mortgage insurance companies out there that actually offer courses for income. Pretty crazy. When I actually turned to being an independent broker, I actually sat for many nights going through these income courses just to make sure that I don't screw up anyone's income when I size up their files. So just a pro tip, something to keep in mind. I may drop a link in the description below, but let's start from the top, which is a W-2 wage earner. Pretty simple. All you really have to do is request somebody's last pay stub in W-2. Many times you're not going to even need to request tax returns for that individual, because the income basically is all listed on the last pay stub of the year and the W-2. And obviously you're going to want to get a most current pay stub simply to show that they still work at the company, right? The lender will do a verification of employment, again, to verify they still work there. And that's it. That's all you're really going to need on a W-2 wage earner. It's pretty simple. Now, you have a 1099 independent contractor. So basically, a person who owns their own business or simply acts as an independent contractor, as a consultant, may get 1099s, meaning they've done work for different companies, and those companies actually wrote off that expense has been issued to this individual or this company. At the end of the year, this individual files their taxes subject to the amount of money that they got on their 1099s, and if they have any other expenses, they write it off, typically on a Schedule C. Mind you, not a CPA, so for any tax advice, reach out to your tax advisor, your CPA, your tax preparer. But for the purpose of teaching you how to size up income, these are the things that you're going to need to look at. Now, most people that run corporations, they run them, I'm in California and Los Angeles, and to my knowledge, typically this is how they run it throughout the United States, is with an S corporation. Most corporations, when you request one, they start off as a C corporation, and then you have to request to transition it into an S corporation. Now, I know you may have a lot of questions about that. We're going to dive into it in just a couple minutes. But for right now, you should know that the income that's going to be noted for an individual who's running an S corporation, and no matter how many of them they're running, right, they may actually take a salary, which is actually required. So you're going to see salary to officers. That would be part of their income. And then the other part of their income would actually be the ordinary income, which is, gross sales minus your expenses. And then what's left over is your ordinary income. In that return, you're going to see something called a K1, which is their percentage of ownership. The K1 will actually illustrate, based on their respective ownership, how much money they've made. And so ordinary income together with wages would actually make up this individual's income. Now, there's more to it. We're going to get into it in a minute, because there's something out there called SAM forms. Now, SAM forms are available through Fannie Mae and Freddie Mac as well. Also, when you go through the income training that I advised you to do through the mortgage insurance companies, they will let you download these forms, and basically every single line item is going to be written in, as an example, a C corporation or an S corporation or a 1065 LLC, which is also a partnership. And you basically write in the line items to ultimately derive as to what the income is of the company. After doing this for an extended period of time, you basically can look at the return and very quickly figure out the income, because there's some add backs to the income, such as depletion, depreciation, amortization, casualty loss only when it's available, any type of a mortgage or liability that's due within 1 year, and then meals and entertainment, and also mileage. So all these things are typically added back into the income to give the person who runs the S corporation credit for their income. All right, so I may put a link in the description below, but just know that you're looking for the SAM forms that allow you to go through a C corporation, S corporation, a 1065 LLC, to basically allow you to break down the income. Now, I'm going to throw another pro tip at you. This may be a little bit elevated, something that you might want to watch a few times to get the grasp of it. Took me a couple years, to be quite honest, to really get good at, understanding the self-employed income. Mind you, more than 50% of my clients are self-employed, maybe more, maybe 70%. So I do understand that piece quite well. But I will tell you something else, that S corporations typically used for businesses. 1065 LLCs typically used for limited liability companies, okay? And also holding companies. Now, holding companies are simple entities that are formed in the name of a corporation to have a schedule of real estate underneath them. So when you see that schedule of real estate, you don't actually have to go through sizing up the income like you do when you have rental properties on a personal return, which is a 1040. Another thing that we will get into, another form that is available through Fannie and Freddie Mac to size up rental income, because people have REO schedules in their 1040s and their personal tax returns. So you use the SAM form again to go through and then figure out what is the actual rental income. We will see a sample of that once we jump onto the computer and size up a file, but for right now, just something to keep in mind. All right, so that is a big chunk of the income. Now, when you're talking about the basics, you're talking about getting paid weekly, you're talking about getting paid bi-weekly, semi-monthly and monthly, and salary. So when you're sizing up somebody on a weekly basis, then you can just multiply that income times 52 weeks. Divided by 12, you got your income, all right? Bi-weekly is a very similar concept, except it's 26 pay periods. So you multiply the bi-weekly salary or payment times 26 divided by 12, you got your monthly income. Semi-monthly is, very similar to, monthly being 12, semi-monthly 24 divided by 12, and then you have monthly, which is pretty simple, right? There's also salary income. So if somebody's on salary, then pretty simple to figure out their income. Lastly, we have bonus and commission income. So mind you, bonus and commission income needs to be in place for a minimum period of 2 years. And it's okay if they move from one company to the next, but you're gonna have to reach out to the verification of employment or the team to make sure that you can get a breakdown of commission and bonus income from the previous employer to show that, especially if it's the same line of work, to show that you have a minimum of a 24-month history to be able to use that income. Very similar to sizing up somebody who is self-employed. You do need to have a 24-month history of them being self-employed to be able to use their income. And if you don't, you can't use the income to qualify. So that's a lot about income. There's a lot more to it. I'll give you more examples when we jump on the computer, but for right now, let's move on to the next video. Okay guys, the next part is pretty simple. We're gonna talk about just getting somebody's ID, their identification, and depending on the type of transaction you're doing, most of them just need one type of identification, so you can just get a driver's license. The one thing that is very important about it is, you would think it's super simple, but you do wanna check to make sure that it's actually not expired. Some of them are. And in addition to it, a lender will actually question the address on the ID. So, typically speaking, we cross-reference between bank statements, tax returns, to make sure that, the address that we're getting is actually accurate to where an individual lives. So what I would do is I would definitely take a look to make sure it's not expired. I would make sure that the address is matching whatever other documentation that you're getting. So when you go through the underwriting process, you don't have those kind of questions come up. In addition to it, if somebody doesn't have an ID, then you want to have something that shows that they are allowed to be here in the States. So it may be a visa, and if it is, going back to the guidelines, you want to make sure that whatever visa you're presented is in line with the visas that are allowed by that particular lender. This again will be in their guidelines to know whether this is somebody that you can help. This is somebody that you can actually give a loan to. You do have people with, it's called an ITIN. An ITIN, an individual tax identification number, is a number assigned by the IRS. And it's basically not the Social Security Administration. It's not the same as a Social Security number, as an ITIN is not to be used for employment purposes. An ITIN is a number. It's only used for tax purposes. So something to keep in mind when you're qualifying an individual is if they in fact have a Social Security number, likely they have credit. If they don't have a Social Security number, they may not have credit. And so an individual tax ID number might be something that works or doesn't work with the lender that you're working with. It's something that you're going to need to figure out. Also, if the person's a foreign national, meaning that they live elsewhere, but they want to invest in America, again, you're going to have to check the guidelines to see if this is somebody that you're able to give a loan to. Now, there are different lenders that do different things, and not all of them are lenders that sell their loans to Fannie and Freddie Mac. And this is the reason why this particular course is structured around borrowers who can actually qualify with their tax returns and are in fact citizens of the United States, right? But that does not mean that there's no alternative to tax return programs such as subprime, as you may know it, or alternative documentation. It's also called non-QM, and those type of products do cater more to people with the individual tax ID number, foreign nationals, things like that. We're not going to get into it. I would say if you are originating Just check with the lender, see what they're willing to do. More than likely, they're gonna have a laundry list of visa types that you can cater to. That's it for me on that. Let's move on to the next video. As we're back, and in this section, what I wanna do is go through some very important things and very cool things too. So what you're seeing here is the landing page of my company, Loanbrook Inc. And the reason I'm directing you over there is because there's all these tools that we can use, and they're kind of scattered throughout the web. And so what I've done is I've kind of put them all together in one place. Now I welcome you to use them. I'm going to walk you through them, and I'm going to start with mortgage calculators. So we have a regular calculator and we have an amortization calculator. Basically, anytime you run a scenario, a borrower is going to ask you for a payment, right? A term, that sort of thing. As an example, if somebody needed a payment on $250,000 at 4.25% for 15 years, it tells you the monthly payment, it tells you the total interest payable, and the total payments for principal and interest. So basically, it's an awesome breakdown. I'm in California, so typically loan amounts are much greater than this, right? So say it was a 500, and let's just say it was in today's market 6%, and let's say it was a 30-year, then, you know, very quickly you can see, now this is only for principal and interest, okay? This is not for taxes and insurance. For taxes and insurance, which would be the full PITI, you would simply have to figure out what is the tax bracket, the property tax bracket in that city or that county. For us in LA, this would be 1.25%. So as an example, if I know that the guy's getting a loan or the girl's getting a loan for $500,000 at 6%, 30-year fixed, and the payment is just shy of $3,000. Example, if they were buying the property for $600, right? And oh well, let's assume something else, because remember something, just little, you know, tips and tricks to keep in mind. 500 right here, oops, 500 would actually have to be 80% of 625, so there'd be no mortgage insurance. Otherwise, you're gonna have to calculate mortgage insurance. And I can show you how to do that too. So it'd be 625 purchase, which is 80% of 500 is 80% of 625. So at 1.25%, I know that the annual property taxes is $78,1250 divided by 12. So I know that the PI, the principal and interest, on an 80% loan to value, meaning they're buying for 625, so there's no mortgage insurance. Loan amount of 500, the payment is $2,997 at 6% for 30 years. 651 is the property taxes. So now I add 2,997.75. I have a payment of $36.48. And then if you want to figure out the insurance, just take the loan amount times 0.3%. This is the insurance for the year, plus 36.48, was it? So this is your full PITI, principal, interest, taxes, and insurance, okay? So you could use this anytime you're looking for a mortgage calculator. Now, some people will ask you to break down the payment for them. And I can show you how to do this, you know, with this calculator here, because, you know, we have both right here. I just went to the amortization calculator, in which, say, you know, you have a loan amount of whatever, I don't know, let's say 601. It's 5.5% here, 6%. And let's say they're putting down, you know, 20%. We want to do 20%. And 30 years, oops, here we go. So, you know, there is your payment right here, your payment amount, your principal, your interest, you know, basically breaks it all down for you. So if somebody asks you, hey, you know, what's the principal? How much goes to interest? You know, they want a full breakdown of it. You can basically just send them a link to over here. They can run, you know, the original loan amount with 20% down. So loan after the down payment, it shows the down payment, it shows the principal and the interest. And then, you know, that's a breakdown right here for you. Now, I mean, if you want to, I can show you a little trick here. And this is actually quite helpful. And I think this would just be taking it a step further. I don't know if we need to go that far, but let's say we were doing this right here, right? And just go back to the original 250, 4.25, 15 years. And somebody asks you, hey, could you just tell me what the breakdown is from interest to actual principal? You could actually do that very easily, believe it or not. Just take 250,000 times 4.25%. This is the annual interest divided by 12. So that's the actual interest. That's the monthly interest. If you go minus 1880.7, this is the principal. 995 goes to principal, and the rest, the 885, goes to interest. You want me to do that again? Watch. 250 is your loan amount times 4.25% is calculating the interest only. So we know that if this is principal and interest, and this is interest only, then the difference between these two numbers is what they pay for principal. That's it for this lesson, guys. We're going to move on to the next chapter. This particular chapter, what I want to cover is, again, going back to the index page of my website, right, loanbroker.com, tools for you guys. Go to resources and forms. Now, there's a wealth of information here that I basically pulled in over the past 6 years from all over the web. And, let me touch on that, because anytime you touch a transaction, the first thing you want to do is get authorizations. So authorizations are generic in your origination software. So remember, we're going to dive into our origination software, which is Calyx Point. It's quite popular. And these forms, they're just going to be there. And if they ever need to be updated, the system will update them. So you could basically just access them. This basically authorizes you to verify the past and present employment, earnings, record bank accounts, stock holding, any other asset accounts. And they further authorize you to pull credit, okay? Order a consumer credit report. So you definitely want to have a borrower sign this immediately as soon as you're done with the pre-qualification, and you know that they're going to be qualified, or you think they're going to be qualified. Send them authorizations. In addition to it, the borrower certification, because this basically says that they applied for a mortgage with us, and they're going to give us all the correct information, and we're going to be able to check that information, and we're going to be able to exchange information and verify information. So you just want to have both of these forms available. I actually put them on the index page of my website in case I ever need to send somebody a link and they can just print them out and sign them. Otherwise, our office will just send them out for electronic signatures. Now, here's another thing, a credit card form. Why do you need it? Well, there's only two things that a borrower pays for in the transaction, and that's credit and appraisal. Now, both of these things could actually be paid by the broker or the loan officer. However, it gets very expensive. And if the deal doesn't go through, it's going to cost you a lot of money. So I suggest you get in the habit of letting borrowers know that there's information that you need from third parties. And that information is something that you don't have readily available. And we need to pay to get that information. So 1 second. We need to pay to receive that information. The only way to do it is to let them know that these third parties, such as credit bureaus and appraisers, are going to charge for their services, and you simply need the copies of those reports to be able to process the transaction. So a credit report up until the end of last year, which was 2022, was about $35. This year, our credit vendor, we use Advantage Credit, just raised their prices to double. So it's like $62, I think, for a credit report, which is crazy. We're going to actually be shopping that to make sure that we're not overpaying. But if you're paying that out of your pocket, expecting to get paid back at closing, and closing never takes place, you might be spending a whole lot of money. So just make sure you have this completed. It's basically the only thing you can have the borrower paid for before you initiate their transaction, okay? Let's move on to rates and market watch. So if you're ever wondering where are the interest rates today, the benchmark for interest rates is the 10-year Treasury note. Now, we are not saying that 3.43 is the rate today. That's not what I'm saying. It basically follows this graph. So it looks like today, if you can see, there was a spike and there was a drop in interest rates. So I would expect the rates to be lower today. And if you look at a history here of, let's say, over the past 5 days, you could see what rates have done. There was a spike here on Friday, and then ever since then, they've been coming down. Today, they're much lower. And you could take it, wherever you could take it a month, you could take it a year. Here's rates over the past year, going from low to high. This is a wonderful, wonderful tool if you're ever wondering what's going on in the market with interest rates. All right, so let's get out of this. Fannie Mae guidelines. This is huge because all your lenders that you're working with are going to have a portal that you could actually go into to check out the guidelines. But if you don't have access to them, you're not logged in, whatever it may be, just go to the actual Fannie Mae website. And this is something that we've already discussed. So if I just go over here and I type in matrix, right? Because I'm already in Fannie Mae, eligibility matrix. You can do the same thing for Freddie Mac, by the way. And then I want to view the eligibility matrix. This is basically what we've discussed earlier in the course, where you can identify, for a principal residence, for second home, for investment property, how much you could actually finance. So first-time home buyer can finance up to 97%. You see how this is national guidelines? So anyone has access to this. Anyone who's selling these loans to Fannie Mae and Freddie Mac. Fannie Mae tends to be slightly more favorable in terms of rates, I find. And Freddie Mac sometimes is more flexible when, there's something outside the box. So you can look at both of them. But, for the most part, they're very similar. So first unit or one unit up to 97%, 95 if it's on a first-time home buyer. And then you have a matrix of 2% up to 85, and then 3 to 4 up to 75 LTV, which means you have to put more of a down payment. You see, it basically breaks it down for you for second home investment. It gives you basically everything you need to know. It also tells you that, you need a minimum credit score here of 620 for, transactions up to 95%. I mean, it's endless, right? So minimum reserves are what you would need. This is definitely something, and it's different programs too. So this is standard. This is home style renovation. This is just a wealth of information to have at your fingertips. If you ever have a question, you go to the guidelines. I'm not going to spend too much time on it because it's basically like reading the Bible for lending. Then we can go to business search. I'm in Los Angeles, California. So if I get presented with a corporation and I want to know if they're active, then I basically just go into the Secretary of State. I look them up. It looks like they're down. Shocking. System outage. But this typically is always up, and you can check out and see if different businesses are up and running, just to make sure, because a lot of times we get presented with a corporation and then we find out that the corporation is not active, and that's a huge problem. So immediately we check it out. We make sure the corporation's been around for 2 years. Remember, using self-employed income to qualify, you need a 2-year history, and you want to make sure that it's active so you can still use the income to qualify. That's all you really need to know about that. LA tax collector. I'm in LA, but you might not be. There is a tax collector everywhere. So you might want to know, or for the borrower, especially after closing, they may have questions about how much of a property tax they owe, what's the bill, are there supplements, a million different things that you want to know about taxes. Every county has one of these. So all you really got to do is go into property tax inquiry one time, and then you can just put in the APN. So as an example, if I go to Zillow real quick, and I put in, any address, it doesn't matter. I'll just put in here, whatever this is just came up. So, this gives you an APN right here. APN is an assessor parcel number. It's an identification of the actual property, right? So it should be like right here somewhere. All right, it's right there. You see that? 55, this is the number. So 5511, right here. 5511. It looks like 014022. See, submit. So inquiry only. There we go. We just found out everything we need to know about their tax bill. They still have an installment due for, let me see, this one is due, balance due is 0, and balance due is 0. Balance due is 0, balance due is 0. Paid amount. So they've paid all this for year 22 and 21. There's a default tax roll here. Redemption amount paid 0. Monthly penalty 109. So they actually owe $9,815 to default tax roll, and it's due. It's updated, January 11th, 2023, which was yesterday. So isn't that crazy? You can find out all this information just by logging into the tax assessor, and you will need this. You're going to look up properties, especially if you do refis, different things. People are going to say, why am I seeing this huge tax payment? Well, we can't close your refi until you pay your redemption amount of taxes, $9,800 here. Very, very important tools to have at your fingertips. And then lastly, almost lastly, opt-out pre-screen. Most people don't know that this even exists. This is an opportunity for you to be opt-out for when you run credit, because the second you run credit, an individual, you or for a client, you become a trigger lead. So what does that mean exactly? Well, you see, we have the credit bureaus here, right? Equifax, Experian, TransUnion. And the second you run your credit, they actually sell your information to a broker like myself, if I want to buy your information for like a couple dollars, to call you and say, hey, are you refinancing? Are you purchasing a home? Can I compete for the business? Pretty crazy, right? So if you want to opt out of that, also, how many times did you run your credit and you got like 1,000 offers into your mailbox at home? You can actually opt out simply by filling this out. Click here to opt out, and it's on our website. It's linked in. So otherwise, it's on optoutprescreen.com. Super, super important. Now, the last thing, which I think is the most important, when you're going to be a loan officer, after you talk to a borrower, they're going to ask you for the needs list. Great, all sounds good. What do we need to do to move forward? This is incredible. So what I've done is very simply, we obviously do more than just residential loans. We do commercial loans and private money loans, construction loans. So when anybody asks me for a needs list, I actually composed the needs list right here on my website. So I could basically just take a link and I can send it to them. This is something that's going to save you a ton of time. And basically, when somebody says, okay, what's next? What do we need to do? You just send them a link for the documents that you need, whether it's a refinance or a purchase, and that's it. And you're all done. Saves you a ton of time, and it's very convenient for the borrower because they can, access it anywhere. That's it for this chapter, guys. Let's go on to the next video. Welcome to Calyx Point. In this chapter, what I want to do is I want to go through the application with you guys, because I feel like most of the questions come up when you actually go through the application. And so there is a pro tip that I want to give you, and that's make sure that whenever somebody is interested in moving forward in a transaction with you or expressing interest, to take the application. This is basically the one thing that's going to separate you from being successful in this business. And the reason is, the more time you spend with somebody discussing their needs, how you can help them, their financial situation, the more likely they are to use you. Okay, if it's just a very cold touch, like, hold on, my software allows me to send you a link, so just here's a link, completed, let me know when it's done, and I'll take that link, I'll load it into my system, and I'll push it to my processor. That's not what people hire us. People, because we differentiate ourselves from a computer, from an electronic system. This business will never be fully automated because people have questions and they need a live person to speak to. That's you. That's what makes you the expert. Also, By taking the application, you get to learn everything you need to know about the borrower, which is huge. There's a million things in the transaction that you're not going to know about unless you have these conversations with your borrowers. So let's start. There's, most of the softwares out there are going to seem overwhelming, but they're not. There are only 4 pages that you really have to focus on, maybe 4 or 5. And this right now is in simple mode, right? So this is not anyone's social security or date of birth or anything like that, just a sample. But as you get started in the application, the basics. Now, I want you to also keep in mind, a mortgage loan application and a personal financial statement is basically the same thing. It's a snapshot of the borrower's information, their assets, their employment, which basically outlines their income, okay, and allows you to calculate their debt ratio, which is basically what we're looking at here on the right. Everything we do, although this seems like just an input sheet, it's not. It's a calculator. So all the information you're giving this application is going to basically translate into ratios, front-end ratios and back-end ratios. And the difference is the front-end ratio is basically the amount of income that you make against the housing expense. That's your front-end ratio. And your back-end ratio is the amount of money that you make against both the housing expense or the proposed housing expense and your current expenses that are listed currently on your credit report. I'm very passionate about this topic because there's so much into it. You miss one thing, and there's a possibility that your ratios may be off, and the borrower then will not qualify. So let's get started with this. The basics of it is just getting the name, social security, date of birth, the contact information. This is very important to get correct, because once you load this into the lender or your processor does this, they're going to get disclosures. And if that email address is wrong, then the wrong person's getting the email, the disclosures, and you're going to have issues. Then you're moving on to rent or own. Typically, every lender likes to see that there's at least a 2-year history of where you've been. And if there isn't, then you have to document it to show a thread of 2 years, unless you lived with family or your parents, right? A lender cannot verify that you've made your rent payments on time. It's almost like credit. So what they're going to do is they're going to request a verification of rent from your current landlord to make sure that you've paid over the past 12 months on time. Just something to keep in mind. Then we go into the type of program that we're going to do. This is very important, and I see a lot of new loan officers messing this up, because if you don't mark the correct transaction, I'll tell you why I say this. A lot of times you have an opportunity to work with a borrower, and then you work with them again, their information is already in the system. So what a lot of loan officers do, they simply copy the application, and you can do that minus the pertinent information of the transaction that they already completed. The problem is if it was a purchase and now they're doing a cash out refi or a refinance or any type of a loan, and you don't mark it here, it's going to screw up your ratios. Note rate, it's just a baseline of 5%, appraised value, sales price, putting down 20%. Right now, we're looking at a loan amount here at 5%, is what the system is calculating, which is coming up with $4,294.57. Hazard insurance, that's calculated based on 0.3% of the loan amount. Property taxes, I'm in Los Angeles County, 1.25%, which gives me a total PITI, principal, interest, taxes, and insurance, of $5,569.57. When you take that payment, okay, and you put it against that income right here, right? So let's just try that for a second, right? We got 5,569.57 over, we see here that in this example, they're giving us 10,414 base. And then there's other income. I don't know where it's coming from now yet. I assume maybe rentals of 13,249, which means that if I divide this over 23,663, that's my front end ratio, 23.53. 23.53. You see that? It's a match. Sometimes the system will actually have glitches. So you actually have to go in manually and make sure that it's done correctly. Also, something that I'm going to throw at you, which is very important, actually didn't know this when I got started, is that when a couple is not married and you have a co-borrower, so as an example, a father and a son, right? Then the application for the primary applicant is taken in the front, and then, since they're not married, you can't put them side by side. So you can run a joint credit report, and then you'll see joint liabilities of both of them, right? And you can choose to omit whatever you want to try to reduce debt, to try to get somebody to qualify. But when they're not married, then you actually have borrower 1, borrower 2, borrower 3, borrower 4. It's layered like an onion. The borrowers go behind one another. You have to run their own credit. You can't run a merged credit. That's going to be a really big problem. So just really, really important to keep this piece in mind. Take note, if you have a borrower who is not married and they have a co-borrower, make sure that the application that you do is behind, not next to, and don't run their credit together. All right, moving on. So now we have, it shows a purchase, gross rent. Now, here's the deal. If you're using gross rents to qualify and you don't put in an occupancy rate, you will not get credit for the income. I know this may be slightly more complicated, but the reason I say this is very, very important. If you are putting any type of rentals into your system, I'm going to show you this right here. You're putting any type of rentals right here. See, there's a rental right there. And that right here is not checked. Look at the ratio. You see 23.53 front, 23.5, because the system hasn't run credit. There's no liabilities other but the proposed payment of the new property. If it did pull credit, then the back-end ratio would be different because there will be more debt. Over here, if I remove occupancy of 100%, notice the income should change. If I do 0, see, 38.32, and the reason is it's hitting me for negative $3,500 in income. So to get credit for the income, always put in the occupancy. Now, occupancy for rentals, because a lot of people are going to have rentals, it's 75% of the rental income if it's not on the tax return. And if it is, then it's 100%, and you analyze on SEM forms the rental and you give it credit. I don't want to get too advanced in this. I just want to go through this application with you. So in this particular case, we went through, we said it's a 30-year loan. It's a 30-year loan, and this is the PITI based on 800,000, 5%, 30 years, base income of 10,414, other income of 13,000. Let's see what this other income is real quick. All right, let's go down here. It's asking me, how are you going to hold title? So this is the second page, right? Moving on to the second page. So it's asking me, how are you going to hold title? Now, that really depends on you. Here it says single man, single woman, tenants in common. This is something you want to ask escrow, and you want to consult with your CPA because it has tax ramifications, right? And then it's asking me where the down payment is coming from. So, you put that in there. Now, here is our borrower. Here's our borrower, married or unmarried, very important. Unmarried means that you were divorced, widowed. In this case, this application actually got updated, to be honest with you. So single would just be unmarried, married, or unmarried. And then we have the present address, and then the mailing address is very important. So if the mailing address is the same, some people don't want their documents or their mail going to the same place where they live. Make sure to pay attention to that. Moving on, this is something that I actually provide to the underwriter when I underwrite with rentals, because what happens is you put in the property address and you go through the whole thing, the PITI right here. And this is, you pull this information from the tax return. And then ultimately it gives you the net cash flow right here. So, I would put in all the information that's coming in from the tax return, and then I would put in the current, PITI of the property, and that will give me negative or positive cash flow. Ultimately, what I would do when I have this information is I would enter it on my rental schedule right here, when it would be right here, okay? This is basically where this information then ultimately will tell me if there's negative or positive rental income. That's the same form that we use if somebody has a DBA, right? Let me move this. If somebody has a DBA, you would use this, which is basically a typical Schedule C. If somebody has an S Corp, which is most popular for business owners, you would use a 2-year average right here. So I'm not so much going to get into this because this is going to be a lot of income. It's going to take a very long time, and I might do a whole different, series on that. Or you could simply get this information directly from the mortgage insurance companies, and I will put a link in the description below. But just to keep going on this one here, right here, we're going to put in the employer, we're going to put in the income, all right? And then there's the proposed payment that was put in. The present is always where the borrower lives right now, assuming right now they're not living anywhere because they're just renting. Moving on. Here's where you would put their assets. Yeah, you typically need 2 months worth of assets to show that the amount of money that you're giving is seasoned. We talked about that when we discussed assets, right? You'd put that right here. I would request their credit right here. Again, this is a sample, so none of this is accurate. And if I submit this, I would actually pull a copy of their credit report. Their credit would be populated into here, all the liabilities. And then with that, my ratios right here on the back end would change because now I've included not only the proposed debt, but all the liabilities that they have on their credit report. And then if it's too high meaning Fannie Mae and Freddie Mac will go up to 50% on a max scale. They like to be closer to 45% of your gross income, but they'll go up to 50%. So if you're pushing 50% and there's liabilities that you can omit, meaning just pay them through closing, then you can reduce debt and still get the borrower to qualify. All right. There's the REO that we've discussed. That's where, this guy right here would come into play. You would basically list out the rentals and then see what the cash flow is. List them all right here. And then this is basically, I'm not going to get into this too much because there's another page on the back here, which is fees. And that's something typically that your processor will do, or your coordinator or your transaction partner. They will request fees for the transaction, whether it's a refinance or a purchase, and they will plug them in. Once they plug them in, it'll be looking like this fees worksheet. I'm just going to use a generic one right here. And when they do that, all these fees will populate. You don't need to know this is going to be way too much information for you. But when you're looking at it here, all of a sudden you see closing fees right here was updated. And so all of a sudden that $1 million purchase with $800,000 loan amount, instead of bringing in $200,000, the borrower now needs to bring $212,000 because your processor or your coordinator put in the fees, unless you learned how to do it, but that's a whole different thing. This section, the declarations on every application, is very important. You need to know if there's been any kind of a derogatory activity with the borrower over the past 7 years. Because if there has, you must address it. You cannot give somebody a conventional loan that had a short sale 4 years ago. That's that's going to be, that's going to be an FHA deal, and that's a 2-year delay. If somebody had a bankruptcy, you're not going to be able to give them a loan for like 7 years. So I'm saying you need to know all this information. If somebody's not a citizen, they need a visa, and you got to make sure that that visa is accepted. I actually had a deal that went to the finish line completely ready to fund, and then they found out that the borrower wasn't a citizen and actually didn't know, and then she provided the type of visa that she had and wasn't accepted, and the whole deal blew, and it looked really, really bad. And so you really got to ask these questions and make sure that that is what's going on. Ultimately, there's government monitoring questions, which basically is a visual observation of your borrower. And if they're not going to answer these questions, you can just fill it out to the best of your knowledge. And that's basically it. One thing that you should keep in mind is keep a close eye on your ratios when you're taking applications, because if you're running their credit, putting in their debts and evaluating their income, and these numbers are higher than 50% on the back end, there's also limitations on the front end. But let's just talk about the back end for a second, meaning that the proposed debt for the property that they're either going to buy or financing and their current debts from their credit report together with the proposed debt that they're getting here is going to be more than 45 to 50%. You should get that addressed, because there's a chance that they're not going to qualify. Now I'm going to tell you one other thing before we wrap this up. Either you, your transaction partner, or your processor needs to update the transaction as you go. So application sent to processing, submitted, approved, clear to close, docs out, funded, recorded. You should have all these dates documented. Now, a lot of brokers, such as ourselves, have our system tied to a CRM, a client relationship management tool. And anytime we update it here, there's an email that goes out automatically, and then the client is updated. So they know that their loan has just moved to application, and they know that it was sent to processing. They know that it was submitted to the lender. It's been submitted to underwriting. It's been approved. It's been conditionally approved, clear to close. Docs have been drawn. It's been funded. It's been recorded. They're made aware of all this simply because we're tied to our CRM, client relationship management tool. Okay, that's it for now. It's a lot of information. If you have any questions about it, put them in the comments below. We'll go through them. Just make note that from the time you take your application and you complete the pertinent pieces of information, such as Social Security, date of birth, income, and I believe there's one more to it. I don't recall from the top of my head. Compliance says you must get a lender's estimate out to your borrower. So keep that in mind. Once this right here is updated to application, then within 3 days, a lender's estimate needs to go to your borrower. If they're a prospect and you don't have those pieces of information, you're in the clear. Once they become an application, you update it that you've taken the full application, and you date it right here on page 4. Right here, interview date. Just make sure that they get a lender's estimate within 3 days, either from your company or from the lender's office, so you stay compliant. That's it for this piece. Let's dive into the next video. Okay, guys, we went through the whole journey of figuring out what documents we actually need for a submission. We figured out how to take a loan application and look at the ratios. And now we're at a point where we have the borrower's documentation, and we're pretty confident that the application that we took is in line with the ratios that they need to qualify for the loan. So what comes next? It really depends on where you work, and I'll tell you why. Because if you work at a bank, then what happens is you typically have a processor assigned to X amount or X number of loan officers. You typically have a checklist of items to make sure that once you submit your file, everything we've discussed is actually inside that loan file. So when that processor receives it, she could basically just scan through it, expect all the documents to be there, and then assuming everything looks good, her job is to push it into underwriting. She has to cross-check everything you've done, including the income, and make sure all the documents are in fact there so the underwriting piece can take place. Underwriting is simply somebody who is able to look at the file, they're licensed, and make a credit decision based on the information that's been provided to them, based on the national guidelines of Fannie and Freddie Mac, all right? So that's typically how it will work on the banking side. Now, on the broker side, it depends on how big the broker shop is and how you're set up. So there is likely either a coordinator or a transaction partner, which is somebody that would review the file with you before it's pushed onto a processor. Typically on a broker channel, there's one processor that might handle all the processing for the office, but there's a transaction partner for every few loan officers. So the job of the loan officer is basically a salesperson. They need to go out to the field, appointments, or build relationships, bring in more business. The transaction partner works with the processor to make sure that everything is in the file, that the file qualifies, and then if it does, then depending on the lender, remember you're a broker, so it depends on where you want to send this file, you would actually package it and register it accordingly, and this is done through processing. So let me break it down for you so you understand better. Most broker shops, they primarily use one lender for most of their QM business, which is the qualified mortgages that use tax returns that are sold to Fannie and Freddie Mac. All right, and so through that channel, there's typically a dashboard where the processor can go in and basically plug in all the information that you put into your origination system. Remember, we were using Calyx Point, so there is a file, they call this 3.4 Fannie Mae file or MISMO file, they renamed it recently, that basically you will take, drag and drop right into the portal of the lender, whichever lender you're using, and then most of the information that you already inputted into your system would auto-populate into their system. I'm only telling you this not because this is your job, but you should understand how the process works, because if you're going to be a loan officer, you want to be able to explain the process to your borrowers, right? Okay, so once this is uploaded, then the lender typically will issue disclosures if all the boxes are checked off and everything that you uploaded meets the requirement of the type of loan that you are requesting. And then the most important piece of this is that once this loan is registered, it's going to be disclosed to your borrower based on the information that you've discussed, based on the interest rate and the terms that you've discussed. There's two documents in that package that are actually most important. One of them is the lender's estimate, which is basically a framework, an estimate of the costs, all right? And then the second one is the intent to proceed. So basically, the borrower needs to log in, review the lender's estimate, acknowledge it, and then do the same thing for the intent to proceed. By acknowledging the intent to proceed, you give consent to move forward. One thing happens typically before registration takes place, well, I guess after registration takes place, but before disclosures go out, is they do get an email saying that they consent to receive documents electronically. Obviously, basically 100% of our borrowers take all the information electronically because it moves a lot quicker. There are compliance pieces in place, and the reason I say that is because until a lender's estimate is acknowledged, you cannot move forward in the transaction. You cannot order an appraisal. There's a lot of things that are stopped. Underwriting will not take place until a lender's estimate and intent to proceed are actually acknowledged. So it's very important that once these items are registered into the system and the disclosures go out, that you in fact have your borrower go in and acknowledge those. Now, there are certain timelines and compliances in place. I don't want to give you all this information that drives you crazy, but typically speaking, like I told you earlier, once there's certain pieces of information that are provided to you, a lender's estimate has to go out within 3 days. That's just a compliance rule. If you're not doing it, you're out of compliance. Something to take up with your office, and they can explain more about it. I'm just going to stick to the process for right now. Once the borrower has acknowledged this, now what the processor does is it takes all the documents that you gave, the assets, the credit that you pulled, basically the income information, everything, and she loads it into their portal, because now the borrower acknowledged that they're interested to proceed. So all their information gets uploaded, and then it goes through a system. Some lenders have it, others don't. which basically checks to see that everything is there. If they in fact say, yep, you've loaded everything, everything is here, we are going to go ahead and assign this now to an underwriter, somebody who's going to make a credit decision on your file for your borrower, which typically takes, nowadays it doesn't take more than 3 to 4 days. When we were super swamped last year, it could take a week. That's basically the registration process. Let's stop with that. If you have any questions, put them in the comments below, and we're going to move on to the next video. Okay guys, so now your borrower acknowledged the disclosures, your processor loaded all their income documents, their assets and everything else for an underwriter to review and make a credit decision. The next step in the process is to order your appraisal. So how does that process work? Well, here's the thing. This might be new to you, it may or may not, I don't know, but the past few years, there's been something out there that's been quite popular, and it's called a PIW. It's a physical inspection waiver. And what that does is there are times that when you run a decision engine, which is what you do at registration by Fannie and Freddie Mac, the system may actually spit out something called a PIW, which is a physical inspection waiver. You may or may not need to get an appraisal report. That's pretty amazing. And how you would know that? Well, same thing, guidelines are posted online. You can Google it, it will pull up, and you will be able to see that. So before you order your appraisal, make sure you didn't get a physical inspection waiver, because if you did, you basically just be wasting the client's money. We don't want to do that. However, most of the time, or say 50% of the time, you actually do need an appraisal. And so that's a pretty simple thing. What I want to elaborate here on, on appraisal is that the loan officer never actually talks to the appraiser. There's no communication between the person actually doing the appraisal to the loan officer. Any lender that you're going to be using is going to have something called an AMC. Now, the AMC is a hub which basically takes the order on behalf of the lender for your client. So the AMC gets the order, and all the appraisers actually work for the AMC. And so the AMC lets them know that there's an appraisal order for this address, this city, and then somebody raises their hands and the order gets assigned. So that's basically how appraisal orders are dispersed nowadays. There's no direct communication between the loan officer and the appraiser directly. All right, so that's something that we should definitely keep in mind. Turn times tend to be approximately 1 week from the time you place the order to the time somebody goes out and completes the order. The average cost for an appraiser nowadays to go out and appraise is approximately $500. However, when it's a remote destination and there's not a lot of accessibility, nor there's a lot of people that are willing to go out to do that appraisal report, the cost could go anywhere between $500 to $1,000. I've seen them that high. So that's something that we should definitely keep into consideration. Now, there's something that I do want to touch on, which is actually probably the most important piece of ordering an appraisal report. Once the appraisal report has been completed, it's going to be sent from the AMC. What happens is the appraiser turns it into the AMC, and then the AMC sends it to the lender. The lender reviews the order before it's actually released. And if there's any discrepancies, they actually send it back to the AMC. The AMC sends it back to the appraiser, makes the correction, and then sends it back to the lender before the report is released. Now, when the report is released, as the broker, as the loan originator, you want to take a look at it and make sure that it's actually as is and not subject to. That's a really big thing, because if the report is subject to a correction of something, that means that the value indicated is subject to the borrower or the seller, depending if it's a purchase or a refinance, having to do something, and then the appraiser potentially needs to go back to the property to sign off the repair and then send it back to be updated. So that's all something that happens when you order an appraisal report. So something to keep in mind. Definitely always check that it's as is and not subject to. And there's another really, really big thing that you should always need to keep in mind is before you order your appraisal, let the borrower know again, it could be a refinance, it could be a purchase, to make sure that the water heater, if it's a tank and not tankless, is double strapped. Make sure there is a smoke detector in every single room and a carbon monoxide on each floor. And if there isn't, again, the appraiser is going to have to come back to take a picture. You're not going to be able to just send a picture and give it to him. That's not how it's going to work. He's going to want to charge a trip fee, which is typically somewhere around, I believe, $150. And it's completely not abnormal, happens a lot. So those are all things you want to look for when ordering an appraisal report. On to the next video. Okay guys, so we registered the file, and actually, there is something I want to mention about that. Even though we're not in that category right now, we're moving on to a conditional approval. But something that I believe I missed, when you do register the file, the one most important thing is to get an AUS, a positive AUS reading. Now it depends whether you're registering it to Fannie Mae or Freddie Mac, but the AUS approval basically says that yes, we will in fact buy this loan. So I didn't mention that on the registration piece, but it's definitely part of your registration. A lot of real estate agents ask you for, the DU, which is a desktop underwriter, the approval, the AUS. That's exactly what that is. It basically says that based on the information that you submitted to the lender will in fact buy the loan, meaning Fannie or Freddie Mac. Just a side note, something to keep in mind. If you have a question on it, drop it in the comments below. I'll be happy to answer it. Moving on to conditional approval. So now our loan has been registered. The borrower acknowledged the disclosures and the intent to proceed. We loaded all the documents for the underwriter to review. First went through quality control, then it was pushed to underwriting. We ordered the appraisal report. Now, just another little tip for you. If you don't know if the file is going to get approved, and you're just kind of hoping it will get approved, then you might want to hold off on ordering an appraisal until you have a conditional approval, simply because if you don't think it's going to get approved, then you might be wasting the customer's or the borrower's money. Now, moving on to conditional approval. After the file's been reviewed by an underwriter, typically speaking, if it's clean, it will just get conditionally approved. And you should know that. But if it's questionable, then what's going to happen is the underwriter may reach out to you directly as the loan officer or the processor, depending on who's the point of contact, to answer some questions about different things that they may have prior to issuing a conditional approval. Something else that you should know, which is not so much a part of this program because we're only focusing on QM loans, but on non-QM loans, a lot of times you have an in-house processor for the lender, not for you, who you go through as a buffer before talking to the underwriter. The underwriter will not talk to you directly. I personally don't like that. I like talking directly to the underwriter. This way, if there's a problem, I can address it directly with him or her. But that's typically how that works. If the file is clean, you will get a conditional loan approval, which basically means that subject to these conditions, the lender will commit to giving you a full approval. So people ask, and this is a very common question, when can I remove my loan contingency? Right? You get that a lot. As a lender, I get it all the time. And typically it comes from the real estate agents who are getting pressured by the listing agent to remove the contingency for the loan because they want them to be fully committed into the deal. They go hard on the deposit. It's very hard for the buyer to back out because they're vested. Now, I personally never advise anyone to remove their financing contingency, but as long as you're in underwriting, meaning you now got a conditional loan approval, is it safe to remove contingencies? Absolutely not, because now you have a laundry list, hopefully not a laundry list, of conditions that you have to satisfy before the loan is actually clear to close, or CTC, clear to close. So these conditions, more than likely, even if it's a very clean approval, you're probably going to have one or two things that you're going to have to provide to the underwriter to satisfy the loan. Now, there's also third-party conditions, which is escrow conditions, title conditions, insurance, a lot of things outside the scope. Appraisal needs to be signed off. Okay, there's other things that happen before your loan is going to be cleared to close. And as a matter of fact, something to keep in mind, just like when we registered the loan, we got a lender's estimate. There was a framework, a breakdown of all the fees, which I should also, pro tip on that, that's going to be exaggerated. Those fees are going to be exaggerated more often than not. And the reason is because if you under-disclose a fee, you as the broker are actually responsible to pay for that fee. You want me to say that again? If you under-disclose any fee in the transaction, you as the broker or the loan officer, your shop, will be responsible to pay for it. It's crazy, right? Even though it may not be your fee and you're simply disclosing it, a third-party fee, if you miss it, you're responsible for it. So the lender's estimate that goes out more often than not is exaggerated, because you can always reduce fees, but you can never add fees on, unless it's an extenuating circumstance, in which case you have to do a change of circumstance, and then the underwriter or the internal team of the lender has to make that change. And if it's associated to a fee, it's typically very difficult. All right, so going back to a conditional approval, there is going to be, once the appraisal is signed off, once the insurance is signed off, and different parts of the loan have been signed off, the lender is actually going to issue a closing disclosure, a CD. All right, and then there's a timestamp on that CD. So from the time that is actually issued to your borrower, assuming you did a really good job with the conditions and you've cleared a majority of them, and now you have the appraisal back, or maybe you have a PIW, a physical inspection waiver, and value is not a concern, a CD will go out. From the time it goes out and the borrower acknowledges that CD, you can only go to docs 3 days later. All right, again, going back to compliance, there's a 3-day grace, a 72-hour grace. Sundays do not count. So you got to always take that into consideration when you're talking timelines as to when, in fact, you can get to docs. If your borrower is hanging out, he got a CD, he never signed it, it's not going to happen. All right, you're going to be stuck. He's going to go back to acknowledging the CD. He's not going to be happy about it. And then only 3 days later, you can release the file, even if it's fully signed off, even if it's CTC, for the file to get an assigned closer to move to docs. I want to throw one other thing at you. If it's a husband and a wife or a pair, and both of them actually have to sign the CD, even if the spouse is not on the loan, to be able to move the file to closing. So just something to keep in mind. That's it for this chapter. Let's move on to the next video. All right, so now our file is clear to close. What's happening next? Now, depending on the lender that you use, there's going to be an assigned closer. And I'm going to walk you through this for a second, because there's these lenders that are very systematic. Again, I'm going to go back to like a Quicken Loans, a United Wholesale Mortgage. Those are very systematic lenders. There's a lot of technology there. You have portfolio lenders too, and typically a lot of them are non-QM, meaning it's not these type of transactions. They may actually do these type of transactions, but they focus a lot on alternative documentation, stated income, bank statements, profit and losses, things of that nature. So when your file is in fact clear to close, now you're going to get an assigned closer to the file who's going to actually balance the file with escrow. And then once the file is fully balanced, meaning they both agree as to how much money the individual needs to bring in to close their loan, then docs will be released and sent directly to escrow or the title company, depending on who you're using. All right. Now, something that I think is important to keep in mind is if you're using a portfolio lender, then what happens is the docs go out, the borrower signs them, they go back to the lender, and then a closer is assigned. They go through the closing conditions, which are typically third party, before they fund the loan. So two different processes. For our sake, and the one that you should be most focused with, is that we're clear to close. A closer is now assigned because it moves from one department to the next. It goes from underwriting to closing, right? Different department. A closer is assigned. Closer reaches out to the closing agent, which is escrow or the title company, but typically escrow. I'm here in LA, California. And then they balance out the file. Once they both agree that the file is now balanced, the loan documents go out to the escrow company. The escrow company schedules, more than likely, a traveling notary to meet with the borrower which typically in California is about a $200 fee. They schedule the signing, they sign the loan documents, they bring them back to to the escrow officer, and then they typically get sent or faxed or uploaded directly back to the lender. Now, there's a couple things that I want to give you. Pro tips is, number one, the docs, if it's an owner-occupied transaction, there's a grace period of 3 days. So it's not like you're signing loan docs and you're funding the next day. That would happen if in fact it was an investment property. If it's investment property, there's no 3-day grace. In addition to it, you may want to look for national holidays because they come often, and when they do, you cannot fund on those days. All right, so just something to keep in mind. If it's a portfolio lender, the original set of docs need to go back to the lender. So if they're local, great. If they're not, got to make sure you account for that timeline. All right, so these are all things that are going to happen once you get your docs and your docs are signed. Now I'm going to get you another pro tip. What happens is, say you signed your loan docs and there's money that needs to be sent to escrow the title company. Unless that money is sent, the lender can actually fund your loan, but they can't actually record it. What does that mean? It means that the lender will go through the process of funding your loan. They'll send the money to the escrow company. Now, it depends on the lender. Some lenders will say, did you in fact receive the borrower's funds? Other lenders, it's called desktop funding. They just fund. It's done automatically. It's in their system and the money goes. Now, if the borrower did not wire their money to escrow or title, you cannot record, which typically, depending on the county, I'm in LA, it's done next day. Other counties can do it same day. You need the money from the borrower. Say there's a marginal difference. If the money is not there, you cannot record. And in some cases, the lender will in fact retract the wire. And oftentimes that creates a very big delay and then refund the loan. So just something to keep in mind. These are all very good pro tips that you should know, and we'll move on to the next video. Congratulations, you funded your loan. Your borrower calls you, he's super excited, and they're asking you, so when is my next payment due? Let me walk you through that. It's very simple. All right, so right now we are in the middle of January, right? I'm not going to quote a date, whatever, middle of January. So when you funded their loan, you funded the loan from the middle of the month, or whatever it was in the month, okay, through the end of the month. That's your proration. So right now, say we're in the middle of January, right? So it goes from January to the end of January. That's a proration of interest if we were going to close escrow today. Your payment, your mortgage payment, is not like rent. It's not paid in the beginning of the month. You actually pay your mortgage payment at the end of the month. So your payment for January is actually due February 1st, right? And you have a grace period until February 15th. And then after February 15th, then there's a late payment until the end of February. And if you don't pay it by then, it hits your credit, all right? So if we know that the borrower was prorated, we just closed escrow middle of January, interest for January was prorated until the end of the month, and their payment is now due in February, but we already paid the prorated interest for January, which means the next payment is for February, but mortgage is paid in the arrears. That means their payment is due March 1st. Did you catch that? I'll walk you through it again. We closed escrow in the middle of January. We prorated interest from the middle of January to the end of January. The payment for February is due in March. So their first payment is March 1st. All right, grace period until the 15th. Late after the 15th, and so forth. So that's how you calculate when the next payment is due. Anytime a borrower calls you, you can just work off that schedule and you can let them know when their next payment is due. As a matter of fact, there is one other thing. There's always a payment coupon inside their loan documents. They can also look for that just in case you don't know how to figure it out. All right, so on to the next video. This chapter, what I want to talk to you guys about is what happens if somebody's not happy with your services and actually wants to file a complaint. So the big brother of mortgage and all financial institutions is the CFPB, the Consumer Financial Protection Bureau. All right, And maybe I'll put a link in the description below so you have access to it. I don't want to spend too much time on this, but I just want to let you know that they can actually submit a complaint about you and your mortgage company. And basically, as you can see here, it says submit a complaint. Each week, we send more than 10,000 complaints about financial products and services. And to find answer before you actually submit a complaint, and this will be for a borrower, these are the type of financial products, mortgages being one of them. And then what can I do before submitting a complaint? Well, they're going to try to reach out to you, the mortgage company. And if you don't resolve the issue, then they're going to be looking online, and this is where they're going to be headed. The most important for me is to include the following, which is a clear and concise about the problem you're having. Be clear and concise about the problem you're having. Include only the most important dates, amounts, communications you've had with the company, documentation, and other things like that. So this is just basically so you know what's going to happen if there is a problem and they can't work it out with your company. More than likely, they're going to reach out to the CFPB. And then how does the CFPB share my complaint data? Well, they're just basically going to reach out to your company. You have X amount of days to reply. It's best to reply right away if you have something like this, because it is, it is very sensitive nature. All right. So that's basically it. I don't want to spend too much time on it, but I do want to show you that, for borrowers not happy, this is the direction they're going to go. This is the information they're going to be given, and then they're going to be able to go over here and start a new complaint. We're not going to go through that at all, but I just wanted to point that it's out there to make you aware of it. Okay, on to the next video. Bringing you back in this video to the index page of my website, because something that's very important and you need to get in the habit of doing that is getting reviews. And so you see here under About Us, I made sure to put this on our website. This way I never actually have to look for it. And so when you click Google reviews, I'll just be redirected there. I never actually have to go there. You see we have 61 reviews, and we're a 4.9 star company. Now, every now and then, you're going to get a funky review, which is basically why we're at a 4.9 and I'm 5.0, of some random person from the web who's just looking to damage your business. That's fine. But the majority of your reviews should be, anytime you close a transaction and people are happy with your services, which hopefully is 9 out of 10 times, because, there's always someone in the crowd that you just can't please no matter what you do, right? You definitely want to ask them for their review, because it doesn't matter when you tell the world about how great you are. The world wants to know what other people think about you. And so I think it's very, very important to constantly ask people to write reviews about your services as soon as you're done with their transactions, so they can see the level of service that you provide. This also makes it very easy for you to secure new clients once you have these reviews up, because you can simply say, okay, well, now we've been on the phone for a little bit. I kind of went through the process with you. I know you don't know much about my company or I am. If we haven't had the opportunity to work together, I would love for you to read some of the reviews that other people have, wrote about us. And then, that would make your decision in using us a lot more comforting. Like anything else, it's basically just like shopping on Amazon, right? What do? We all read the reviews. We want to know if it's a good product or a crappy one. Are we gonna have a problem as soon as we get this thing? And especially in, home loans and mortgage and finance in general, this is like the biggest pieces of our lives, and we want to make sure that the person handling them is going to do a great job. What I recommend is two things. I recommend to post them onto Google, and also if you could just ask your borrowers to basically cut and paste them into Yelp, because the more good feedback there is about you and your company out there, the more likely you are to get business, the easier it's going to be to get business for you. So here you go. We have 23 reviews here on Yelp. Everything is 5-star. I think anyone at this point that is considering using our services would feel very, very comfortable, and you should build the same level of comfort in your business. And remember, because you're starting from the beginning, these are the type of things that you definitely don't want to overlook, especially as you get started. Reviews, super important. All right, on to the next video. video, I want to go through the loan estimate with you. And the reason I want to do that is because most of the complaints we just talked about in the previous video are going to come from people thinking that you overcharged them. And I think that it's super important for you to know and to be able to go through this with the borrower to make sure that their mind's at ease. They know that you didn't overcharge them, especially first-time home buyers, especially people that have never gotten a loan before. And it's very important that you understand that when you issue a lender's estimate, not only will it have the information of the loan that you guys discussed, meaning, the loan amount, the interest rate, the payment, it's actually going to show if there's a prepayment penalty, if there's a balloon payment. It's going to break down the escrow payment, which is typically the taxes and insurance, as you can see right here, $206. And it's also going to point out if there's mortgage insurance. So all these things are very important. However, what's even more important is the fact that it points out that there's approximately $8,000 in closing costs. And now, as a consumer, you might think that that's extreme for a loan that's $162,000. And at that point, your mind is spinning and you're thinking, I think I'm being taken advantage of. So it's very important for you to be able to explain this in detail as soon as it goes out to the borrower and ask them if they have any questions about it. Something else that I really like about the loan estimate is two things. One, that if you're being shopped by other mortgage shops and the borrower tells you, yeah, but I can get this over here, you can simply request a copy of the lender's estimate. It's also called an LE. And it would actually tell you the terms. So basically, they're going to have to put them in writing. And something that is even more important is they're going to have to tell you if the loan is locked. And if it is, then they actually secured that interest rate that they're talking to you about, and for what cost, which we're going to see on the next page. See right here, locked until. And so that's a very, very important component, especially in a moving market, because if they haven't locked the interest rate and yesterday's rate was a lot cheaper than today's and they got quoted yesterday, then you know that it's not going to be factual, right? So moving on to the next page, because this document is a couple pages, it actually points out to you the different buckets of closing costs that are associated with the transaction. Your focus should be right here in terms of where your actual fees are. And what you can see here is if I just hit this little box, and I'll put a link to the description in the bottom so you can access this as well. It tells you that the points that are associated with this loan is actually the fees that a borrower pays towards the interest rate, right? So as an example, if the interest rate today is 4%, which it's not, it's probably closer to 6%, and the borrower wants to get like a 5.75, then they might end up paying like 0.25% to lower the rate, right? In this case, $405. And this would be actually money not paid to you. It goes directly to the lender, whomever that is, right? And then you have an application fee. I don't know what that is. We don't have one. There could be some junk fees in here. We're only going to focus on the, on the factual fees. Underwriting fee. That's a fee that is associated with every single transaction, guys. And it's typically hovers right around $1,000. For portfolio loans, it's closer to $1,500. So two things that you're going to look for over here. You're going to look for any kind of discount points, which are coming from the lender, any kind of underwriting fee. And then we're going to look for one other fee, which is your origination. If you're doing, as a broker, a borrower paid loan, where you're actually giving away your rate for being able to charge the borrower typically at least a point. All right, so you would see that in the first bucket right over here, loan costs. Now comes the part that you don't necessarily control, which is services that the borrower cannot shop for, which is it's broken into appraisal fees, credit report fees, flood certs, tax certs, things of that nature. They don't shop for that because once you place the order to the lender, you register the loan and you get an AUS approval, DU or LP. Remember we talked about that? That's when the real estate agent tell you, hey, we want to see that you ran the desktop underwriter for Fannie and Freddie Mac, and we want a copy of the AUS or the DU. That would be, all these things that you go through to be able to register the loan and then put in an order for the appraisal, which comes out from the third party AMC. We talked about that as well, right? So we don't have any communication with the borrower. And then credit report fee, we talked that comes from a third-party vendor that, again, we simply request the report and then we use it, right? So those are fees that they can't really shop for because we're associated with these lenders or the lenders associated with them. So that's the second part of the transaction. And then the third bucket here, services that you can actually shop for. In a purchase transaction, remember, you act as the loan officer. You don't actually pick the escrow or the title company. More than likely, the seller or the real estate agents do. Or in slim cases, maybe the buyer. So you simply disclose their fees, and you want to make sure you disclose them correctly. One second. Sorry. Disclose them correctly, because if you don't disclose them correctly, you're going to end up paying for them, okay, for the overages. So make sure that you ask for a closing statement and you disclose it correctly, or you over disclose it to make sure that, if you're under disclosing it, you're not going to have to pay for it. So over disclosure is perfectly okay, or get an estimate from title and escrow, make sure you're disclosing their fees correctly, right? So that's services they can actually shop for. Title insurance, in this case, pest inspection, survey fees, title and escrow, but you're simply disclosing them. Look, we're already at $5,672 in costs, right? And what was your cost? Well, nothing, because the points was actually paid to the lender, and the underwriting fee was paid to the lender. Unless you're a direct lender, you have an underwriter sitting in your office, which typically isn't the case. So you basically have no fees here. You're getting paid directly by the lender. Yeah, there's $5,600 in fees. You want to make sure that the borrower understands that. Moving on to the second column right here, other costs. There's recording fees and taxes, transfer taxes. It's not much. It's $85. The more important piece of the puzzle here is the prepaids. From the time that the transaction is closed to the end of the month, we talked about that as well. There's prepaid interest, right? And then because you pay mortgage in arrears, the payment is due the following month. But that prepaid interest is something you pay through the transaction, and it could be 1 day, it could be 30 days. We don't know. It's listed here as an estimate. And then also, when you do a purchase, typically you pay for insurance for 12 months up front. So that's also listed here. So just the prepaids are $867 for insurance and prepaid interest. And then we move on to impounds, which is an escrow account that you have that's actually listed on your mortgage statement. And it basically says that, there's X amount of money that's been injected in this account for both property taxes and insurance. It's broken up. And that money goes to, disperses when taxes and property insurance are due. So that's a savings account. And that's, another thing that's basically just, not really associated with a transaction because it's paid for the future, but the borrower still has to inject money into it. And then one other thing that I want to tell you about that's actually really important, so please make note. In a refinance, a person may say, yeah, but I already have that. Why do I need it again? Can't I just transfer the data from one lender to the next, or the account? The answer is no. You have to, one gets closed off, they get a check, within about 14 days of any monies that are in that account right now. And then they have to open a new one and inject money into the new one. So they'll get credit for the old one in a couple of weeks, but they have to open a new one. And then the last piece of it, as you see here, is owner's title insurance policy, and it's $1,000. But I've never really seen anybody buy that, because typically the only title insurance you buy is right here, is the lender title policy, which secures the title's position to make sure there's no clouds on the title. That's it. So looking at all that, we have $8,000 in closing costs for $162,000 loan right here going back. Yeah. So that's how you explain it, $8,054. So you got to make sure that you have this piece covered. Now, one other question they're going to ask you a lot is, yeah, but I issued a deposit in escrow. It's a purchase. In this case, $10,000. Did they account for that when they're telling me how much money is estimated cash to close? In this case, yes, you see it right here. The down payment and funds to close from the borrower are $18,000. There is $8,000 in closing costs. They already issued a deposit of $10,000. There's a balance of $16,054 to close. Lots of information. I'll put a link in the description below, going over the lender's estimate, just making sure you put your borrower's mind at ease. And this way, you don't have to worry about getting any negative comments or borrower looking to complain about you in the future. On to the next video. I talked to you guys about being able to get the information about sizing up deals from the mortgage insurance companies, MGIC. I'm showing you exactly where you can get this information in addition to the SEM forms that you need to put everything together. So MGIC /underwriting /SEB /cash flow. I'll put a link in the description below, but just so you get an idea of what it is, updated cash flow analysis worksheets for 2021. So you can get them for self-employed borrower worksheet, self-employed and rental worksheet, income training webinars, right? And so as you scroll down here, self-employed borrower webinars, so evaluating base and variable income, rental income, personal and business tax returns, getting started with a sole proprietor, partnerships and S corporations, and potential impacts from COVID-19, right? On SEB income, self-employed business income. So this is it. All you got to do is come over here, spend some time, go through these. A lot of these webinars have already been pre-recorded, which means that you don't necessarily need to register. You just, you just watch the recorded version of it, and you could just, take notes, do a quick printout of some of these cash flow analysis worksheets, plug and play. It will actually show you samples of tax returns, where the information is coming from, how it flows through. The only reason I say that, to go through that is you're obviously not trying to become an underwriter. You're probably not trying to become a processor. And if you are and you're watching this, then there you go, free training for you. A lot of these trainings are actually things that you would pay thousands for, and they're available for you for free. I sat down through a lot of these when I started my business back in 2016, simply because I wanted to be ahead of the curve. I want to make sure I understand income very well. And, I can have an intellectual conversation when I speak with an underwriter about a borrower's income. I don't want to feel like, now, mind you, it's not about feeling like, you don't understand, because you're constantly going to learn more and more and more. But just to have a strong foundation is key, because this way you could build up your skill set. If the foundation is weak, it's going to be very difficult for you to become a very strong loan officer. And I feel like selling for me hasn't really been so much like applying sales tactics as much as it has been educating my clients, and then by them kind of talking to me and talking to other loan officers, feeling like they're getting a lot more value in terms of the information that I'm providing, has kind of naturally made them gravitate towards me and give me the business. So that's kind of what I'm trying to pass on to you guys. It worked for me. Hopefully it's going to work for you. But that's all you really got to do. And then, there's other tabs here like underwriting, training, so forth. All these will have different videos in them that you can go through and learn more. That's all I got on self-employed income training and other forms of training. They also have appraisal, processing, underwriting, a bunch of videos you can check out. Enjoy them. Let's move on to the next video. Right, so we went through a lot of technical videos about, sizing up income, sizing up the deal, making sure you stay compliant, walking through understanding, lender's estimate, figuring out where the training videos are. Something that I think we should transition into is really you have to think about marketing from the beginning that you start your business. Now, it doesn't matter if you're starting a shop like me. It's okay if you're just working for a shop, because as a loan officer, technically speaking, you're an independent contractor. Basically, the way this is going to work is a couple ways. Number one, either you're 100% commission, right? In which case your commission rate will be higher, or the broker sees that you're a pretty good salesperson and might put you on a modest W-2 with a draw every single month, in which case they will reduce your basis points for the amount of money that you receive when you do close a deal. All right. And typically when you do close a deal, you're still going to have to pay back the draw against the commission. So I guess it really depends on how the structure of your pay will be. However, whichever the structure is, you need to start thinking about marketing day one. And something that I found slightly down the road, and the reason I have this window up, it's just because I get solicited all the time by different wholesale lenders that want me to join, become an approved broker with them. I don't know who this person is here, but the reason I have them up is simply because if you're using Google, and a lot of people are, you see this little plus box right here? Anytime an email comes through and you press that add to contacts, that person is added on to your Google contacts. And what's great about that is you don't want to miss out on being able to solicit all these people that you have conversations with. Now, I don't mean lenders, because they're not going to give you business. Unless you're a very big producer and you do things outside the wheelhouse of what they do, just like myself. I do a lot of commercial and private money business. I do construction business. And because I work with a lot of these referral partners, they may get a request for things that they just don't do. And so they may ask me if this is something that I want to look into. And then I might get that lead. However, in the beginning, it's fair to say that you're simply trying to originate residential loans. And if you're talking to a real estate agent, or if you're talking to a CPA, if you're talking to a listing agent, you might be helping a selling agent. A selling agent is somebody who represents a buyer, but maybe the listing agent is also on that thread and you're having a conversation with them. Make sure to go on, hover, it's going to look like this, right? When you open the email in Gmail, and then you basically go over here and then you see their contact and add them on to your contacts. Because what's going to happen is, as you add more and more people to your contact list, you're going to be able to extract that list from Google and import it into platforms that you can market, such as Constant Contact, which is what I use, my company uses. And so what I'll do is I'll take these contacts and I will filter them into Constant Contact as a list. Let me show you something. So same thing. Remember I was showing you Point, my Calyx Point software. It has a lot of contacts in it. So what I would do is I can extract, not through here, but whatever. I can extract those contacts. So what you want to do, you always want to make sure that whomever it is that you're talking to, you're constantly having access to being able to gather up their information. And then this way, when you are, hold on. This way, when you're trying to build up your list, you have more and more people that are constantly joining that list, whether it's from your origination software, whether it's from your email, emails that just constantly come in, and then you filter them into a program such as Constant Contact, and then you're able to constantly touch these people that they'll never forget about you, right? And I think there is a massive difference between email marketing that you compose your own messages, to the email marketing that comes from, like, as an example, a CRM, because you could tell that it's very generic. So as an example, the Point contacts that are loaded into my system are automatically being solicited through my CRM, which is the client relationship management tool. All right. So these are things that are super important, because once you get busy and you're doing a million different things, you don't have time to go back and start shuffling your cards and figuring out where these things are. It's really good to have a client relationship management tool, because people get happy birthdays. When transactions are updated, they will constantly be updated, automatically. When when there's a holiday, it will send out an email, and then people will reply, "Oh, Zevi, thank you so much for the email." I don't really do anything. I just put their contact in my system, and the system automatically sends out those emails. So this particular piece of the course, I just want you to know, gather your contacts from day one. Make sure you compose them into a list, whether it's Constant Contact or your origination software. This way, when you start tying in your systems, then everything gets solicited and your face is constantly out there. All right. That's one way of doing it. And I think it would really help you out. All right. On to the next video. This piece I want to talk to you guys about people being able to reach you. With every single email that you put out there, make sure that you have your full contact information. All right. And now, this is something that I think is super important. And I will explain to you why. Because when someone is trying to reach you, and this happened to me so many times, I'm talking to you guys from experience here. I've tried to reach real estate agents religiously who have no contact information in their emails. They simply reply back, it might have their name, and that's it. And so always think somebody's trying to reach you to give you business. You've went through the motions of, showing them how great you are. You've solicited them. Your emails need to have your signature. Now, depending on your company, they may be lax about it. You shouldn't be. Always make sure that every piece of correspondence that you shoot out has your full signature, meaning that all somebody needs to do is pull up just one of your emails and bam, they're able to reach you. Make it as easy as possible for people to be able to reach you. I can't emphasize that enough. That piece by itself will give you a lot more business. In addition to it, it looks 10 times more professional when somebody sends me an email with their full contact information. Then I simply get their first and last name. I personally don't take that person nearly as seriously as I would when I get something that is a lot more detailed. It actually sets the stage for the type of transaction and person that I'm going to be dealing with in the future. So I'm very, very, this is something that really bothers me when people don't do it. So take the time, spend, whatever, 10, 15 minutes, set this up for yourself before you get started. Now, I'll tell you one other thing. Your safe license needs to be on everything that you put out there, which is your NMLS license. So if it's not there and you're corresponding, you're also in violation. And you never want to be, It's not that you're unpurposely going to be, but it's just something that you could always go back to. And when somebody edits your work, they can always see how diligent you were. It's just a big bonus. So anyways, put your signature line on everything so people can easily reach you. All right, on to the next video. If you haven't seen my YouTube channel already, this is it right here. And my YouTube channel is something I've been working on for the past year. It's always a work in progress. I have about 6,000 subscribers. And if you haven't subscribed to already, please support me. Subscribe to it. Give this video a thumbs up and write some kind of a nice comment underneath. And I'll tell you why. Because the Google algorithm, which is basically the Google audience, understands that when you're interacting with something, it gives it a lot of strength. And then Google understands that people are interested and it keeps pushing content of that sort to that type of a user. So it's the only way to be able to grow your channel and also your subscribers. All right. So the reason I'm actually talking to you guys about this is not necessarily to promote myself, but since you're getting into this business, you have to really take a close look at the platforms that you're already using to advertise yourself. Now, I personally don't really post mortgage content or my work to my personal Facebook. A lot of people do, and that's perfectly fine. All right. I just don't like to solicit friends and family, even though in the beginning, it's a great way, it's a springboard. You don't want to bother anyone with a bunch of posts, but every now and then you want to sprinkle them in. That's perfectly okay. There's a couple places that I can give you my input that would really help. One of which is LinkedIn, as an example. You can ask anyone and everyone on LinkedIn to be your friend, and more than likely they will be. It's just one of those professional platforms that everyone wants to get their business out there. So when you're asking people to be your friend, more than likely they will be. So basically, you can sit there and every single day, ask for 100 friends over a month. And then in a month, you can have 3,000 friends. In a year, you can have 30,000 friends plus. And that equals an email blast, right? That you never even have to pay for. The second you post, they see your videos. Isn't that crazy? So imagine that if you start putting up videos and you share those videos on professional platforms like LinkedIn and you befriend a bunch of real estate agents, imagine that. The power of your voice, the power of you being projected over such a huge audience, and you don't even need to pay for a platform like a Constant Contact or any type of an email. campaign. You just have to do it. You just have to make these videos and make sure that they get pushed forward. YouTube is great because not only do you create a post, right, of your face, but you also have the opportunity to speak. People actually get to know you. And it's one of those things that don't ever think that one video is going to go viral and that's it. People are going to start using it. It's never going to happen. This is something that typically takes a very long time, at least a year or two of you just telling people what you do, showing people how professional you are, sharing the guidelines with people, telling people about deals that you closed. There's so much to it, but over a long period of time, you basically build yourself an audience of people that are likely to use your services. So it's just something that you got to be very, very steady with. It's the same concept as working out. You can go to the gym today and tomorrow and next week, and you may not notice a very big difference. There is a difference being done every single time that you work out. You just can't see it. So it's the same concept. Imagine that over a period of a year, 2 years. Clearly, you're going to see a massive difference, right? And it's really the same concept. So I really think that you should pick your platforms carefully. If you're going to appeal to a younger generation, then TikTok is good. Facebook is typically an slightly older generation. YouTube is just the platform that you can, make these videos and then just sprinkle them around the web. So put them on LinkedIn, put them on TikTok, put them on Instagram. All of a sudden, you have a lot of eyeballs on you, and people are starting to get to know you, even if you're simply sitting in your office and not even going out on meetings. That's number one. Number two, the strongest way to get business is basically to build relationships. And that's the truth. Because people that are watching you online, they will get to know you over time. It will take a very long time. But, to be able to go out there, have a personable conversation with somebody, talk to them, follow up with them. The money is in the follow-up. It's not in the actual meeting. I don't care what you talk about. Don't even talk about more when you meet somebody. But just have a conversation with them, enough where you can build up a rapport to the fact that they think you're knowledgeable, whether you are or not, and they like you. Those are the only two things that you have to accomplish. And then everything else is in the follow-up. This is not something that you can think you're going to establish in 1 week. It's going to take years to build up those relationships. And these people are in the business for a very long time. So if you're starting out young and you want to appeal to your peers, a lot of people will gravitate towards you because you're speaking their language. You just got to stay with them. Don't fall off the face of the earth, and don't veer off, and don't look for side hustles. You got to be vested in the craft. Otherwise, it's going to be very difficult for you to stay consistent, to become better, and ultimately to be a big producer, because it's hard to do 20 different things successfully. 1 or 2 max, right? And hopefully it's around the same wheelhouse of what you're trying to do. So I would definitely suggest to you to consider doing a YouTube channel. And when you do a YouTube channel, focus on the content that you're going to be pitching people consistently. Don't talk about, X, Y, and Z and ABC tomorrow. Make sure everything is in line with what it is that you're going to be talking about tomorrow, which is you becoming a loan officer, you telling them about different products that are available, showing them, different people that you've helped with, basically establishing yourself as the go-to person in that field. All right. This has basically been my work over the past year. In addition to originating mortgages, you have to do something that you're very passionate about. If it's something that is basically just a job for you and you don't really care for it, it's going to be very, very tough for you to continue building and building and building. All right. This is what I got for you guys. There is so much more to cover in terms of marketing. The quickest way for you to be able to get leads, I'm just going to put it out there as maybe the last thing, is you can always buy leads from the credit bureaus, because anytime somebody runs their credit, they become a trigger lead. Unless you opt out, and there's that link on my website that I showed you, you can access it through the resources. And if you put your information, you or the clients put their information in, they will not become a trigger link. Otherwise, anytime you pull somebody's credit, expect that client to be solicited. So what I would highly recommend that you do is one of two things. One, let them know that that's going to happen. And number two, you could use your company's fax number instead of their personal number, so your client doesn't get solicited when they're putting in their information. Clearly, they didn't ask to be solicited. We covered a lot. If you have any questions, but whatever else we covered, which was a lot, let me know. I'm happy to help. I'm here to help. I want to support you. I want to see you become successful. The reason I'm putting this video up in general and on YouTube is I've been going through the journey for the past, 8-9 years as an independent owner, probably for another 3 years working with other companies. And I have all this knowledge bottled in my head. I want to make sure I get it out to the universe. I want to grow, a community. And so if you have any questions, any comments, please drop them in the comments below. Let me know. I would love to help you. I'd love to see you succeed. Check out my YouTube channel. Please subscribe to it, share it, and I will catch you guys on another video, another time, and maybe another course. I appreciate you guys being here and supporting me, and I'll talk to you later. Thank you. Bye.